Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are you're watching this video because you found out about it from a blog post or you got an email from me telling you that it's up. Now, if you're not on my free email list, you need to get on it because every single morning before the open, I'll send out an email with the top headlines of the day that I'm following and trading ideas in my blog post. So you got to get that. Click the link in the description and you'll see how to get on that free email list. Now, I'm doing this video on the weekend, Saturday, August the 14th. And I think it's good to look at things on the weekend while the stock market is not trading in order to get a much clearer idea of what's going on. And that's what I want to focus on is the big picture by looking at charts that go back years. The thing is, when you look at the market during the day, during the trading week, what your mind will focus on is the daily gyration. And that's what you're going to see. That's what the news media shows you. What is the Dow doing? What's the price of gold doing? If you load up your Robinhood app, what are you going to see? You're going to see the daily gyration. You're going to look at that Robinhood top 100 list and see how much things are up or down that day. But the reality is daily action typically doesn't mean much. And that's what you're fed all the time. Daily action, daily action, daily action. Well, when the market is closed on the weekend, there is no daily action. So it can help you be more calm about what you're seeing. You don't have people yelling at you, telling you to buy or sell. You don't have the daily gyration impacting your mind either. You can look at things and by looking at it when the market's closed, do so with a sense of calm that can help you better understand what's going on and make plans or adapt if it's necessary for you to do so. So let's just step back right now together. And let me show you just a few charts. We're going to talk about gold. We're going to talk about the stock market, try to figure out what's really going on and what's likely to go on from now to the end of the year. So I got to load up my chart and share my screen so you can see what I'm looking at. Now, we're looking at together a chart of the S&P 500 going back 20 years because I want to make one simple point that I think is the most important factor now when it comes to stock market. Now, obviously, the stock market has gone up a lot since it crashed last year in the spring, the 2020 decline. And many people have gotten into trading for the very first time as the market has rallied after that drop. Now, what I want to point out is what the indicator on the bottom of this chart is showing us. It's a rate of change indicator of the 90-day average movement of the price. And what happened last year was the steepest decline and then jump up in regards to points down, then points up over on this 90-day indicator ever, except for actually it's faster in a shorter compressed amount of time. But you got to go back to the drop in 2009 actually to see in rally off the low to see similar price movement for what we saw last year from March to Labor Day. Another similar decline and then rally, though, took place, frankly, in 2002, 2003. But the movement last year was historic. And when you see a historic decline and then rebound in a compressed amount of time, that has implications for what the market is likely to do from then on. And what it amounts to is you're going to see the price gyrations spread out over 90 days shrink it's an extreme movement up and down, and that extreme price movement is actually going to shrink. This is called price volatility. So one of the things that has happened and has been happening really since last fall is price volatility in the stock market is shrinking. And this has caused that 90-day price indicator to fall from 40 down to around 10, where it is now. And that indicator is likely to trade in a range of 10 as the high and negative 10 as the low here for quite some time, perhaps for years. And it did that, in fact, from 2012 to 2018, when the stock market dropped 20%. But from that time period, from really 2012 till the fall of 2018, it did that. That indicator traded in a 90-day period plus or minus 10. In other words, the stock market the S&P really didn't decline more than 10% or rally more than 10% over a 90-day period. Now, we can see a similar period actually happen from 2004 to 2008. Although I didn't put a rectangle around that period, but it did happen. So these periods of heightened volatility, like we saw last year, or we saw in 2009, or we saw in 2002, are actually the exceptions. I mean, if we went back on this chart for over 100 years, we'd be seeing the same thing. These periods of heightened volatility are short-lived periods. Most of the time, the volatility in the stock market is not as extreme as it was last year. So many people got into the market last year after the crash played out and saw this huge gain, and they experienced that. And in their experience, that's normal. Reality rallies that straight up are frankly not normal. And the momentum in the market has slowed down since June. Not only that, but many stocks inside the stock market actually peaked in February. That doesn't mean the stock market's going to collapse, but that means many of the stocks that went up the most last year actually peaked in February are now lagging the market. This is why many of the top 100 stocks most owned in Robinhood that are stocks like that went up the most last year are now lagging the market. The ARK ETF is now lagging the stock market. And the ARK ETF is made up of so many of these stocks. Now, I'm going to talk about gold in a minute. But the ARK ETF, on the bottom is the indicator, ARKK divided by S&P 500. That's a ratio. When this ratio goes up, ARK has outperformed the stock market. That indicator peaked in February, and while the S&P, the Dow, the NASDAQ made new highs at one time or another in the past month, this ETF remains well off its high. It's floating right on its 200-day moving average. And there's stocks inside this ETF that are below those levels and are in downtrends. That's just what's going on. You know, there's a rotation out of these stocks that began in February, and it's still going on. There's no reason to think it's going to change. I can get more deep into that, but I want to return back to this. What's the stock market going to do? Well, the odds are that the stock market, basically, after having gone up so much, isn't really going to do a whole lot one way or the other for months, perhaps for the rest of this year. I don't really think there's tremendous upside from here, nor is there likely to be tremendous downside either. Even, when the market makes a major top, such as it did in 2007, it can spend a year in a range. So if we're going to top, we can spend a whole year floating above this level and 4,000 or something. And that would be a situation where not much is happening. But maybe the market isn't going to top. Maybe it's just going to pause like it did, let's say, between 2004 and 2006. Or look what happened after 2009, when the market made a bottom after the 2008 crash. a tremendous rally up, but then it spent really between 2010 and 2012 not doing much. And periods where it doesn't do much can go on for a year, 2 years, even 3. So I think we're in a situation where the market probably isn't going to do much one way or the other. That doesn't mean money can't be made in the market, because there'll be select sectors that continue to grind higher. There'll be select stocks that continue to grind higher, even if the S&P 500 doesn't do a whole lot one way or the other. And there's also going to be stocks that fade, 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 fade. So what I'm personally doing is focusing on owning sectors and stocks that I think can outperform the market. Energy, REITs are 2 of those sectors, and shorting and betting against stocks and sectors lagging the market averages that I think can fall now, even if the S&P 500 doesn't decline. That's a subject for another video, people. But I just point out that the internals of the market are weakening, have been weakening since June. This indicator shows us the percentage of stocks trading above their 200-day moving average. And while recently the S&P and Dow have made new highs, this indicator has been trending down since June and is weak. This is because a lot of stocks are fading, that not so many that the averages are going down. In fact, the averages can even continue to go up with this indicator weakening, and this indicator can weaken for the rest of the year, and the stock market continue to be okay. That's a deeper topic, and I can show you examples of that, and probably will in another follow-up video. But I'm just giving you an overview of the big picture, of this. You're not the daily gyration. What does this suggest? This chart suggests that we can see we're already seeing a slowdown in the upward momentum in the market, a shrinking of volatility. Those 2 trends are likely to simply continue, and we can get a period of the rest of the year or even longer where not much really happens. And the daily gyrations, therefore, become even more meaningless, even if it's what is, your mind focuses on every given trading day. And it's all you see in the Robinhood app. No charts going back for more than a year, no charts of indicators, no useful information to be used to even identify winning sectors. That's why you got to get beyond that app to be a winning trader if you're entering the trading world through that app. So let's turn to gold. And what's the big picture for gold suggest to us? Because gold took a hit in June. Gold retested its March low just this past week. This has brought in crash bottomers, bottom call, people predicting gold crashes. But when you look at the price of gold, gold is trapped in a range. It's still in a range with the high around 1900 and the double bottom now as support, roughly right off 1700. So gold is in a range, and these movements are all within the range. And that's what's going on. And the gold had a big rally, you can see, from 2019 really till last August, and has since been trading in a range. And gold has often spent time trading in a long drawn out range. It did it from 2016, in fact, to 2020. It did it from 2013 to 2015. It did it from 2006 to 2008. Did it in 2005 and 2006. It did it for over a year, 12 months in 2003. Range bound times happen often with the price of gold and silver. And that's what's going on. So the gyrations you see every given day should be understood to be happening within an overall sideways trading range. That range will be broken, and then a new uptrend begin once gold busts through 1900. But now we're near the lower part of the range. So I think it's a buy point. But, until it goes through 1900, there's not going to be any interest among individuals for most people to get involved in gold. The masses will remain asleep. because what they want to do is buy something they see go up day after day after day for a week or two on Robinhood and then jump in. You know, that's why they got so fascinated by Bitcoin in January and these fad stocks in the fall last year, and then they peaked. But they want to get in something they see go up, 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 day after day after day, many days in a row. Gold really hasn't been doing that. It needs to go through 1900 and then go on one of those marches to get individual investors, small traders involved in it. But I just want to repeat, the big picture in gold is that the recent decline is not a sign of a coming collapse or new bear market. It's happened within the context of a sideways range. And this is only one of many sideways ranges we've seen in gold for the past 20 years. It's nothing unusual, and it's playing out. And the indicator on the bottom is the 200-day Bollinger Band width indicator. The 200-day Bollinger Bands are the pink indicators around the chart. They also are a way to measure price volatility. That indicator is at 13. It can get below 10. In other words, this sideways range can continue long enough to push that indicator below 10. That seems to be where we're heading for. You know, when we went to 1800, we retested resistance at 1825. It looked like a chance to bust it, but it failed, and then we dropped back down. So we're still in the range. I'm not going to try to predict ahead of time the date, the month it breaks it. I don't have a crystal ball. I just take long-term positions and use dips to get in. This is the dip, get in. And then you're in, and then it busts, and then you got your position already. I'm not a chaser who likes to chase, you know, up, 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 up stuff. That's why, you know, I bought stuff last year, you know, not now in the stock market. So these are the big picture things I just want to leave you with. You know, if I want to sum up, how do you make money out of this? Focus on stocks, focus on sectors, trading better than S&P 500, and buy dips in stuff that you believe in as long-term investments. And don't put much stock at all right now in daily price action, daily gyrations, daily news. It's fairly much noise and meaningless. And if those things are provoking you into taking trading decisions, it might be time to discipline yourself and get away from the market for a while, or look at this stuff less often than you're doing. Maybe just look at it after the close instead of during the day or in the morning, or look at it only in the morning. And then, like when I send out my morning email, and then look at it after the close. If you are not planning on making a trade during the day, then there's no reason at all to watch the market trade or look at the daily gyration. Look at the news before the open, look at the news after the open, ignore the trading day unless you're really planning on making a trade ahead of time, because that can provoke you or make you think you should do something when there probably isn't much you should be doing right now. But being more patient in these markets, that's what I'm doing. I've got positions I'm holding. I've reduced some risk in my accounts because we've had a tremendous run up, and I like to have cash reserves in order to buy dips when they do come. So, you know, I'm not on margin. I'm not 100% invested in the markets. I'm just, you know, it's fun to look on the weekend and get a better idea of what is happening. So all that said, I'll be talking with you later. Oh, if you're watching this on YouTube and you've encountered me for the first time, click the subscribe button and then click the bell next to that. And then YouTube will send you an alert as soon as I put up the next video. And also like this video so that I know you're out there. Encourages me to do another one. The last video I did got fewer likes than the one before that, so I wasn't as excited to do this video, but the video is finally up. So put that like button to work, and I'll be talking with you later on.